What's up, everyone? Welcome to the Moving to Florida show. I know you guys are not hearing Judson's voice as the intro because he usually does the intro. It's Mo this time doing the intro. Judson is not here today. Unfortunately, he had some prior engagements, but we do have a special guest today. Well, he's not a guest today. He's going to be a co-host today. We've had him on the show before. His name is Yaya Chotani, and he is with PRMG. He's a lender with PRMG. And what's up? What's up, Yaya? How's it going?
What's up, bro? I'm awesome, man. I'm excited. So today I get to be the co-host with you.
You're going to be co-hosting today.
Whoa, this is pretty awesome, bro. Like, this is exciting, man. I get big things are happening in life.
I know. So, as you guys know, Yaya is a lender. As I spent some time with him in the past. We had him on the show before. We've talked about some of the lending programs that he had. But today we're going to change it up a little bit, and we're going to be talking about almost anything under the sun. So, well, when it comes to real estate and, money and inflation and all that good stuff, all the fun stuff that we talk about on the show. So we're going to be talking to an expert today on the lending side of things and what he's experienced this last couple of weeks. He was in Vegas recently, and so I'm not gonna talk about it anymore. So tell me, how was your Vegas trip?
Dude, it was awesome, man. It's really interesting you said that we were here. I remember now. We did the Hometown Heroes podcast before.
We did the Hometown Heroes podcast,
so
right?
Anybody who doesn't know what that is, guys, listen to it. Awesome episode. Me, Mohit, and Judson talked about this really cool down payment program, which is still available, by the way. But the money's running out. So if you're trying to buy a home, I would highly recommend going for that.
Yep.
And yeah, dude, so Vegas, it was amazing. I've never been there. And the first thing I realized was how incredibly complicated the airport is.
What do you mean?
So when you get there, apparently they have a special area where you have to walk all the way from the main terminal to get your Lyft or Uber. It's not on the main terminal. I didn't know that. I'm like, hey, dude, it was cold. I was wearing a t-shirt from Florida, man. I was like, dang, this is but it was interesting. I've never been to a place where you're allowed to smoke inside a hotel. So that was a new thing for me. I was like, not feeling it.
Vegas is a little bit more. I think Vegas has always been that way, but they do have now areas and sections where it's not like non-smoking areas and whatnot. But yeah, it's all over the place. As soon as you get into the airport, there's like a glass box with the smokers in there and gamblers in there.
Yeah, that was the weirdest thing. You get to the airport and you're like, man, there's slot machines inside the airport.
Yep.
And there's people actually sitting there inside the airport. I'm like, okay, man.
Yeah. The games begin as soon as you land.
I know, it's pretty crazy. But you know what, man? I think the coolest thing about Vegas to me was being able to eat at some really awesome places. Like the food there was exceptional. They have some Michelin star restaurants. Gordon Ramsay's restaurants are there.
Right.
You've got Hell's Kitchen, which we were there most of the time. It was I got to tell you, man, it's you want to get fat, you got to go to Vegas.
But I hear you didn't just go to Vegas for fun. You went for a convention, I heard. Okay, what was this convention all about? What was it about? I mean, was it just more lenders everywhere, or was it a different type of crowd?
So it was mainly for mortgage professionals because this was all about, the thing is, it's called Momentum Builder, and they do it every year. But this year was a little special because we had some really cool speakers. Okay. And one of them is Lacey Hunt. He's one of the top economists in the nation, and he's also a former Fed chair. We had David Rosenberg, who's also a chief economist, and these guys are also asset managers. And there was a lot of other speakers there. So the energy was very high. Right. But the cool thing about this place was, it was about 300-400 people. And a lot of us from the mortgage industry a lot of them have been doing this for 20, 30, 40 years. And people that have really lived through the times. And what was interesting, if you notice, most people don't know much about the financial markets, capital markets, inflation, right? And with the recent way the world is, there's no need to know a lot of things either because it's so specialized that if I don't work in this industry, I'm not going to know much about it. And to find out, social media, the internet, news, there's so much misconception, so much information, the way information is projected that it's not easy to understand. So we do these events to kind of get together collectively and mastermind together, present facts, and figure out a way to simplify this information so we can give it to the general public.
Okay.
So it's easier for them, instead of, like me talking to you right now, instead of projecting 100-year chart in front of you and say, hey man, so that's nobody has time for that, man. It's
You're
like,
gonna,
bro,
start hearing me snore.
not even that. It's like, I invited the wrong person to this podcast. And I made him a co-host.
I made him a
like,
co-host today.
like,
You're gonna have to
whoa.
take your co-host
Exactly.
card away from
Exactly,
you.
dude. So it was kind of like, a bunch of us getting together, sharing information. And one thing people don't know about lenders is that we're nerds, man. All we do is sit behind a desk and literally
Number crunchers.
Not just that, it's like research, bro. Like,
Yep.
And this is funny. So most people don't know this, but the biggest part of my job is to read.
Yeah. Well,
I'm reading guidelines. I'm reading the economy. I'm trying to understand different products. We have there's so much that
Right.
I have to know. And, as a borrower, when somebody comes in, they want to know, what's my monthly payment? How much do I get, in terms of affordability? And
Right.
what's this going to cost me in the long run?
Okay.
And the most important thing is to be able to guide somebody properly, tell them how it's not just a mortgage payment, but it's a long-term wealth building plan, because we're in the real estate industry, you and me.
true.
We help people make money passively, right?
We try.
You live in a house, right? I mean,
Yeah.
think about it, man. Like, take yourself as an example. You bought a house recently, right?
Yes.
And before that, how long did you live in your house?
Well, before I get into the apartment, I was in my house probably about 3 years, 2018 to 2021.
So you were one of the smart guys that bought a house at the right time, made a bunch of money. Yeah, see? But you see, that's the thing, though, right?
Right.
So
Right.
that's kind of where we were going with that, is to be able to share this information in an easier fashion with the rest of the public,
True.
like we are today. So we're going to drop a lot of cool knowledge for everybody here, and it's going
Yep.
to be really fun. And I promise I'm going to make it as exciting as I can.
Sounds good. So, what is one of the first lessons you learned when you got there, or one of the first things that you learned and that blew your mind? Like, oh snap! I was going to drop the S bomb,
So
because we're not usually, when me and you talk, we I mean, there's no filter, but now
we have to behave
we're on a podcast,
ourselves,
kind of be on a filter a little bit.
So on
what is
that,
some
I'll
of
tell
the-
you something funny. Right on that. So when I got there, I don't drink, by the way. I don't drink, I don't smoke. But when I was
boring.
there with 400, especially in Vegas, like, you don't drink. I'm like, no. How hard for you to believe? Man?
Smoking, I can understand. No smoking, great. No, drinking, come on. No.
Yeah, like, dude, like, if you work in the mortgage industry, there's two things you have to do:
Right.
you drink and you curse, or you do
Yeah.
one or the other.
One or the
And
other.
And I'm like, well, I think I curse quite a bit. It's like, okay, well, you're normal.
You're normal. There you go.
But one of the things I think when we opened up, this presentation, one thing we all had to agree upon was how the state of the economy is right now, because it's painful, man. Everybody is, in this inflationary period. Things are expensive. Eggs are like, price of gold. The real estate agents are making jokes about escrow payments of eggs right now. You know what I mean? There's memes. But the thing is, the reality
$7
is,
for 12 eggs. It's insane.
that's what I'm
bro.
saying. But you see, what that led to is, okay, we're here now, but why are we here? What
Right.
caused this to happen? Why are we in this situation? And the thing is, because this information can be so easily confused, this was the beginning part of our event.
Right.
And we just went over some basics that, 2021, when inflation first hit, our Fed chair said that it's transitory, whatever, it's going to go away. But that wasn't the case. It was the opposite. It was like on fire. And mortgage rates move with inflation. So a lot of people that were buying homes, including yourself in 2018, right? You enjoyed the lower payment. You're like, cool, man. But the thing is, as inflation rose in 2021, mortgage rates followed. So you saw rates go as low as 2.25% and rise all the way up to 7.5%, almost 8%.
Which is unheard of.
And that's what people think, right? But when you look at the past 100 years, rates used to be at 15, 20 even percent, and 8% and 6%.
I understand the high rates being around, but going up that fast, that quickly, that's what surprised me.
And you see that, so that's a very good thing you brought that up, because I was diving into that anyway. Right. And it's cool because it naturally became a part of this conversation. So why did that happen? Well, how come rates went from 2.25% to 8% in less than a year? What happened there, right? So when the Fed says inflation is transitory, and they rigged the game, basically. They rigged the game, right?
Yep.
So they went in and they saw inflation was increasing, So they did a quantitative easing by giving people a lot of money. And they also started buying up mortgage bonds in the
Right.
billions. They were buying in reinvestments plus new purchases, almost $110 billion worth of mortgage bonds every single month.
Right.
So because they were creating this artificial flow in the market, it was keeping rates artificially low. It was just keeping them down. And there
Right.
was no need for them because inflation was rising. So as they kept doing this, and they talked about, okay, as soon as they mentioned the word like, hey, we got to stop doing this, the market had a reaction and the rates started to go up. But then when they stopped buying mortgage bonds, you saw inflation was already rising and mortgage rates went up 1, 2, 3, 4, 5, 6%. It just shot up in the sky.
Yes.
And that's
absolutely.
why this happened. So because they rigged the system, they caused this, they let inflation run hot initially. And when it ran hot and they tried to artificially control it and they couldn't control it, then they stepped their foot off the gas, but it was too late, man. The damage was already done.
Damage was already done. Is this gonna be like a trend type of thing? Like they'll keep doing this, they'll bring it down for a few months and then bring it back up for a few months. Is that something that are you going to be seeing like a seesaw effect on that?
So it's interesting because the Fed's goal is always to have a 2% inflation. That's what their
Correct.
target is.
Yeah.
Now, the way to do that is either they increase the Fed's fund rate and bring the economy down a little bit, right?
Right.
And then things come back to normal. So they started doing that. They rose 75 basis points for a couple of months, then they did 50 basis points. Now they're doing 25.
Right.
And we are seeing CPI numbers come back down.
Okay.
But the cost of this, there's a cost to it. It's not just going to happen overnight, right?
Right.
So if you're doing this, it's a lagging indicator, which means that if I increase my Fed funds rate this month by 75%, I'm going to see the result of this effect in 30 days. So because they'll do this, they'll see it backwards. So now, as an economy, we feel that pain immediately. Like if you had a HELOC on your home equity
Right.
line of credit, that's rated by the prime rate plus the bank's rate.
Right.
So if that was, let's say, 2% plus another 2%, 4%. But now the Fed's trying to go up to 5%. Plus on top of that, let's say 4.5%, you add the bank's rate. Now
Right.
you're looking at a ridiculous amount of money that doesn't make it worth it for you to invest money.
Right.
Plus the cost of things is more expensive. So now it's causing, basically in simplicity now to talk about inflation, inflation is too many dollars chasing too little goods. Right?
Right.
And how the Fed reduces inflation is interesting because 80% of the money right now in this country is credit.
True.
80%.
Yeah.
That's so the Fed can increase the cost of borrowing to reduce credit, like we're talking about, to reduce the money out there. But again, this is going to shorten and contract businesses because capital expenditures are going to reduce. People, the first thing they do is let go of employees. They're like, "All right, man, we don't need you." I mean, I don't have
That's
enough
usually
money.
the first step is employees.
That's the first step.
And that's what we're seeing.
Employees.
We're seeing all these IT companies starting to lay off 10,000, 12,000, a certain percentage of their staff. And I guess that's usually the first step of a induced recession. I mean, I hate using the R word, but but it's something that we're going to see or are seeing.
Exactly. And that's the thing. So now you do this and the economy slows down. Now what happens? Of course, you're going to cause unemployment. You're going to cause it to slow down demand. Basically, you're trying to kill demand, which is good. Of course, it works, but it wasn't a necessary thing that we had to do. We could have done better before. But
Right.
now that we're in this already, for reality to hit now, as the CPI numbers come in lower and lower and lower, it means demand is lower. Plus, recently today, numbers for retail sales actually came in pretty strong. So
Yeah.
it seems that demand is still there, but
Right.
it's imagine this like a roller coaster. You're off the hump like this. So
Right.
the front is seeing something else, the back is seeing something else, the middle is somewhere else.
Right.
So I'm looking at the front, I'm looking at the data, and I'm like, okay, based on this information, we're going here.
Right.
But we're here. And you're seeing this here. So there's three ends to this. So because of this, it's a very interesting cycle when you understand how this works. So as we go into the coming months, the target is most likely going to be hit. I mean, the way they're going, most likely they'll get to their 2% rate or 3%. Based on what we're looking at just in data, I think we probably may reach mid 3 or 3% by the end of the year because they
Okay.
did announce that they're going to, see the unemployment rate hit about 4.7%. Now, when they're saying that, they're not projecting this. They're telling you they're going to make unemployment 4.7%. Because
This is all self-induced. This is all self-induced.
Exactly. Just think about it, man. People forget history, but if you look at history, it will help you. Look at every time the Fed makes a statement, somehow magically it happens. It's because they're causing it. So
they're causing it. Yeah.
1% is like what, 1.5 million people about to lose their jobs. So
Yikes.
Yeah.
That's tough to hear, but at the same time, wages are still going up. People are making a lot more money than they did a year, 2 years, 3 years ago. Whoever's in the workforce is making more money now than they have in the past.
I'm glad you brought it up. So think about this. That's a tool, by the way, that economies and banks have used over and over and over to basically inflate their debt, right?
Right.
So if you took a loan from me for, let's say, 5% for $100,000. Mm-hmm. Now, inflation goes up, cost of things goes up, but at the same time, my income goes up, unrealistically goes up.
Right.
So I make more money, but I still owe you 100,000.
Yep.
So I can pay off that debt faster because I make more money.
Right.
So my currency is getting a little devalued at this point. Mm-hmm. But the thing is, big countries like the US can't do that. We can't do that because the problem is, if we devalue our currency, it's going to cause global recessions and problems because we are a reserve currency. So small countries like Mexico has done that multiple times. Other countries have done that multiple times. You'll see they'll devalue, and then because our debt just got washed away magically, boom, gone. But we can't do that, unfortunately, because we have to carry the weight of the world, being one of the leading economies. So, man, it's
we can't devalue our cash flow, our dollar.
But what's cool though? What's cool is if you think about it, man. So, do you look at the treasuries by chance?
The treasury bonds, a little bit. Yeah, I have to because that correlates with your interest rates.
Exactly. Now the cool thing is, when interest rates were low and inflation was low, we had very little incentive to save. People were spending money because you were not saving enough money.
Right.
If you look at short-term credit, like a 10-year treasury, it's paying you more. So you can get a CD investment and make money on interest right now in a bank.
Right.
Versus long term. So it's very interesting when you see how things work in that. But like we talked about the shelter costs, it's heading downward. Mm-hmm. So hopefully in the coming months we will see it comply. And March 14th is an important date. And the reason why is because it's going to have the CPI number for the previous month. And we're expecting to see inflation lower because compared to 2021, in the beginning of the year, 2022, the beginning of the year, we had very high numbers.
True.
And because the numbers were high month over month and they reduce month over month, we're going to see a drop. So hopefully if that works, you will start to see mortgage rates come back down slightly, which will be better for buyers at this point.
So me and Judson made predictions for the summer, or not for the summer, for this year, and we predicted that he predicted that housing value will continue to come down a little bit, not a lot, but come down a little bit. He also said rent values are still going to climb, and he also said that interest rates are going to probably be still hovering around the 5% mark. Is that something that you're seeing? And I'll give you my prediction. My prediction was, I think housing will maintain its value. It will go down a little bit, but I think it's going to come back up towards the end of the year. And rent, we both agreed that rents are still going to, start climbing because of the influx of people that we're getting here. And I think we might see if rates in the 4s. That's what I was predicting. I was saying, and I think we haven't seen a healthy market yet. We're still in a seller's market. I mean, there's still only 3 months worth of inventory. Our numbers just came out this morning for January, so we're going to talk about that in a later episode. But yeah, we're still not seeing foreclosures either. Our foreclosure numbers are still very, very low. Foreclosure percentage. So going into foreclosures now, that's something that you see before I do. So what are you seeing as far as homes going into foreclosure or homes not going into foreclosure? What are banks doing to because it costs a lot of money for banks to go into put a home into foreclosure. It costs them probably more than what the house is valued for sometimes. So, what are you seeing as far as the housing forecast?
So that's very cool. So there's a bunch of really cool stuff you actually asked over there, and I was going to get on that anyway, but I'm glad we're on the same level here. So one thing about homes is, and you're going to know the answer to this, and you're going to appreciate this. So if you take a 10-year chart of inventory for houses, right, for homes, and you'll see there's cycles like this. Now,
Right.
every year, parents who have kids that go to school, like yourself,
Yep.
they move at a certain part of the year because let's face it, I mean, kids are really mean. Okay, when you're a new kid in school, it's and I'm gonna relate to this. Trust me,
Yeah.
they're
Yeah.
mean. So if
Yeah.
I'm a new kid moving from
Right.
this school to that school, and I meet a guy like Mohit who's super mean, he's making fun of me all day. I'm just saying, right? That happens.
Yeah.
Or what's the coolest thing about this country, which I find amazing, is no two schools teach the same way, grade the same way, have the same curriculum. It's weird, right?
Right.
So I go to your school, I'm a genius.
Right.
I stay in my school, I'm not. So it's very difficult for parents to plan. So they want to start where school year start either in the beginning or it's like a brand new cycle. And I think that starts in August normally, right? Like
Yeah,
later
schools
part of the
start
year.
in August here in Florida. I know
Right?
up north it's after Labor Day or it's in September.
So
But
think
yeah, it's
about
usually around the end of July to mid to end of August. That's when you see a
Right?
huge influx of movement.
So that's when you see the movement. But if I was to sell a house, I was a seller and I got kids and I want to move in by July, August, because I mean, you want 30 days to relax and chill out and have your home ready. Obviously.
Accumulate with everything else,
Right?
get
So let's
familiar with
say-
the areas. Yeah.
Let's say June sounds like a good idea, right? Gives you a month about
True.
to move in, to be moved in and ready.
Right.
But to sell your home, especially in this market, you need like what? A bunch of days. I would
Right
say at
now, the
least.
average days on a market is about 57 in Central Florida right now. So you're
that's an
talking about if you had to close in June, you're talking about April.
There you go. So I didn't even have to ask you that. You just
Yeah.
said it. So think about this. So right now we're in middle of February.
Right.
And March, April. That's the cycle. March, April, May. And if you go back 10 years, you will see that is the height of inventory every single year.
Right.
For the past 10 years, I've seen this, right? And I just pulled up the chart and I'm like, fascinating. So every year, same time, people list their homes, sell their homes, move into their homes. So they're ready by end of June, July, August, whatever that is.
True.
So we haven't seen the real inventory hit the market. And the funny thing is, because 80% of the money out there is credit, and we just crossed the year end, how many people spend money on their credit cards end of the year buying Christmas gifts with money they don't have, buying new cars, setting up things, right? So it's credit card bills. Now, when you own a home, you have something called appreciation, which builds equity. And a lot of times, being a homeowner is so beneficial for this that you can wash away your debt, even if you made stupid mistakes,
Right.
and pay that off at closing and walk away with some money. Or buy another house or just rent for another year, which it's okay. No shame in that, right? But so that's the cycle. So I don't think we've seen the real houses hit the market. We're going to start seeing them. So that's the first thing. The other thing, very cool, you said about foreclosures was CBS had a Market Watch headline that said, dramatic increase in foreclosure filings are up more than 150%. Now, what they failed to say was that was what they compared to 2021.
Yep.
And we couldn't foreclose in 2021 because there were moratoriums for 18 months.
Yep.
So-
Forbearances and moratoriums.
So
yep.
I got to keep my language cool here.
Yeah.
That was a total BS of a news piece. Like, who compares that? Like, that's
Right.
But the thing
Right.
is, media's job is to get bait, click, and
Right.
sell news. And then when you read it, you're like, oh, I just clicked it for no reason, right?
Right.
So that was
Right.
very, very misleading. Now, if you compare that to normal, they don't tell you that 15% is what's in a really good year on your foreclosures. Because on average, 500,000 homes go into foreclosure. People lose jobs. Things happen. Life happens, man.
Right.
But, and then 5% is 5% compared to really good years. Now, of course, that's not good news. It's not going to create panic like, hey, our foreclosure numbers are only 5% compared to the last 50 years.
Right.
But it's like, 150% foreclosures compared to 2021.
It's 2008
Fine print.
all over again.
Yeah. So because the next thing you asked about, foreclosures, did you know, man, that because people right now have up to 58% equity in their homes as an average.
Yep.
58.
Yep.
That means
That's
your mortgage
huge.
is only 42%.
That's
So,
huge.
first of all, if somebody says, I don't want to buy a home after listening to this, man, I mean, either you lost your mind or because imagine 58% equity,
Yeah.
58%.
That's huge. That's a huge number.
So let's put that into perspective just for the fun of it.
Yeah.
So if my home is worth 400,000 and 58% is $233,000, that would
We
leave
could
my
have kept
debt.
it at 100,000, man. It would have been so much easier.
But I want to make it realistic.
Realistic,
because,
okay, yeah.
Right? Think of,
Yep.
can you buy a home for 100,000, man? Where are you buying it? I mean, tell me, where are you going to buy a home?
You can't buy a house
There-
for 400.
Exactly.
At
That's
least
when,
not here.
That's
Well,
when,
you can condo.
right? Yeah, I think even condos now with the fees are ridiculous. But
Yep.
if I say 400,000, 58% is 232, leaves me at a debt of about $168,000. So would it be good for me to have $232,000 that are tax free? I can pull out, and I'm going to pay less in interest than I would pay in taxes if that was earned income. If my kid wants to go to the best college, I can withdraw that money, do that. I want to buy a car, I can do that. I want to invest in other assets, I can do that. Or I can refinance my house and pay off, other high interest loans or credit cards or whatever I have and secure that into one low interest debt. So why would you not do that? So
Right.
it's interesting. And the media, the thing is I love how they like to manipulate people and create panic and show you things like, 50% more inventory right now. Like you were talking about, hey man, so if I compare inventory back to 2021, where there was literally nothing available for sale,
Nope.
and I say, hey, inventory is up by 50%. We're in a housing bubble. Compared to 2021, where you had to pay 50,000 over market.
Yep.
So what they somehow again magically miss is that was a 1 year comparison. So of course there is more inventory. But if you look at a 10-year chart, if you look at 10 years again, man, you will see the cycle. March, April, May, you will see it go up.
Yep.
Later part of the year goes down, goes up, goes down. So right now, if you look at overall inventory in the entire country, I think you're less than 1 million homes for everybody out there to buy. So when we talk about a bubble, back in the day, were you licensed in 2008? Because I wasn't.
I was not. No.
You were not. So I read the guidelines. They used to call them ninja loans. Basically what they meant was, hey, Mohit, bro, listen, what do you do for work, man? Nothing, dude. I just chill at home. All right, listen, how much home you want to buy? 500,000? Cool.
Yeah.
You got any money?
Yeah.
I got no assets. Just sign right there, man. It's fine. It's okay. It's cool. That's it.
Gotcha.
That was a loan. No asset verification, no income documentation, no ability to pay, no truth in lending act, nothing.
Yeah.
High cost loans, and everybody was involved. So it was terrible.
It was what was it called? A no doc loan. If you put 20% down, you didn't have to show any documentation at all that you have any kind of money.
But the thing is, if you have 20% to put down,
Yep. You have assets.
You have enough skin in the game. And so, the thing is, it's very unusual for somebody who has invested 20%, $80,000 on a $400,000 home to default. It's very rare. But the problem was no income, no problem. No assets, no problem. No credit, who cares? Your 500 credit score, here, man, you can buy a home right now. And there's a really good movie on this. If nobody has seen this, it's called Big Short. Really nice movie.
Great movie.
Very good movie. Awesome movie. And really depicts exactly what happened. But interesting enough, when you're looking at a bubble, and by the way, to put things into perspective, that is the only recession caused by real estate in the entire history of the United States recessions. No other recession was tied to real estate. So people need to understand that, because everybody always talks about 2008, where, it's a tough subject, but that was the reason. It was not anything else. Today, 58% equity, how can I foreclose on somebody? How am I going to kick you out of your house, man? And you're making your payments, plus you said people make more money. Yeah. So you make more money means you can pay more money. Right. So it's like a balance, man. Yeah. Yeah, man. Yeah. So what else did you learn out there besides all that stuff? I know you got into really deep into I know you guys went deep into inflation. You guys went deep into foreclosures and stuff. What else did you guys go in depth with? One thing very, very interesting was that it's really cool, man, when you have like economists that study things all the way, because we don't have time to even look at all that, knowing all the things we know. So one thing we learned was very cool. So when the stimulus money came out, everybody started spending. And when the second one came out, people paid their debts.
Correct.
When the third one came out, they spent more. Yep. And when that started to happen, people started spending a lot more money. People are buying, Gucci bags, Prada, like all this kind of stuff, and you have money to pay for it.
Right.
Now, and people got used to it. They liked it. They enjoyed it. It's like, man, I could use another $2,000 in my bank account. No, come on, you know what I mean? It's like, I do nothing and I make money. But the problem is you're creating all this credit, because now, if you think about it, pre-COVID, we had a savings rate of 10%. People had 10% saved in their accounts. Mm-hmm. Post-COVID, we had a pathetic 2.5%. Yeah. 2.5% average savings from 10%. So just think about cash. Nobody has it. Now, when you go into the balances, before that, the record of credit card balances, the highest ever, was $850 billion.
Right.
And right now we're at $930 billion, almost $1 trillion of credit card debt. So that can't last forever, Right. So you are going to go into a recession, and of course that will kind of help us a little bit. But here's the thing: there's a misconception recession is bad. Okay, it is bad, sure. But it's a way to reset the economy. There's no other way either.
It's like a reset button. You're absolutely right.
We're like France or Germany, where if you remember, they had such high recession that a loaf of bread cost 1,000,000 francs or whatever. People started killing each other. Right? It was insane. King Louis XIV was literally murdered at a history level in France, right? Because of inflation. He was killed. I mean, it's no way to live, man. But so, it's painful, but it's not bad for housing. Because if you think about it, it's the opposite. And yes, and I'll put this into perspective. So unemployment goes up by 1%. We lose about 1.5 million people with jobs. Now we're going to say like, oh, we lose 1.5 million sales. Well, not everybody is qualified to buy in that 1.5 million, right?
Right.
Not every person that does an application is ready to buy. So let's say 1.5 million lose their jobs. Not all of them are qualified. But now rates are going to come down when inflation comes down because of recession. So now we have about for that, about roughly, if inflation drops, let's say, let's say if rates come down, mortgage rates come down by 1%, you have roughly 5 million new buyers that become qualified. Right. So that can overwhelm the market a little bit, right? So now you were talking about home prices. Now, yes, home prices will appreciate. They may not appreciate in the double digits. They may appreciate in the single digits.
I think between 3 and 5%. Yeah.
Exactly, like lower single digits, they'll appreciate still. But even with the appreciation, of course, you have all the supply in the early part, spring sale, basically. So that's going to cause a very big benefit, because if I'm a buyer right now in this market, I am excited because I'm thinking, why would I pass up the opportunity? And if you look at the MLS, I mean, you probably can see these things, but the price decrease chart is like this long now.
Yep.
Withdrawn is long, and price increase is this much. And I mean, when you look at pricing, especially in really hot areas too, homes are listed, man, for active days in the market, 90 days, 120 days, 157 days, 80 days, 60 days. And you see the price history, first day to 3-4 days later, 10,000, 5,000, 8,000. So from the price they started, they're now in some areas 30, 40, 50 grand less. So they're coming back to normal. But what's even cooler is that sellers are now actually buying the rate down and paying concessions for buyers, which is amazing.
Yep.
So not only
talked about that. Yep.
Right. So, dude, I mean, and you tell me, because you're the expert here. So if I come in and I'm like, Mohit, bro, I'm well qualified, I'm good. I see this house, get it to me at a discount, man. Like, I want to get it. Now, when we think about this as an opportunity, last year when I overpaid for my home by 50 grand at a lower rate, right? Now to recover that money, obviously it's going to take me some time because I overpaid.
Right.
So it was not worth that much.
No.
But if I take a higher rate and compare this, and I pay a little bit more extra per month, but the seller is actually paying this for me.
Right.
So my monthly payment remains, even if I get qualified, by the way, at the main rate, that's the higher rate, but I'm not paying that payment.
No.
And I'm getting the property at a discount.
Correct.
And what you said is
you're getting twofold. Not only that, we used to remove inspection periods. We used to remove appraisals.
I didn't even talk about that. There you go.
Those two pieces as well. We were just talking about this last week, me and Judson, and we were like, yeah, you know, because I'm in real estate and we're real estate agents, you're a lender, we're in that environment. People think that we're just saying this just to get sales. And I hate that concept. It's like, if you find I always say everyone needs to look at their own pockets and then make that decision. See if it's the right time for you to buy a house. Now, that's your personal decision. Our professional decision, our professional onlook of what the market looks like right now. This is the best time to buy, because homeowners, home sellers actually are giving out deals. They don't want to, and they know they have, like you said, 58% equity. They have a lot of wiggle room. Some more than others, but for the most part, they have a lot of wiggle room. So if you want to get a rate buy down, you can possibly get a rate buy down if the home has been sitting on the market for too long. If you want, closing cost assistance, that can happen too. Obviously, there's a percentage of, you can't ask for 100% of, closing cost assistance, because, it depends on if you're an FHA loan or a conventional loan or some other loan. You can probably cap out at maybe 6 or 7%. I think FHA cap
6%.
6%. And in
that's
conventional,
a cool thing, man. So you brought up some really fun stuff, dude. So that's important. I think everybody, guys, you need to understand this, because yes, last year you had you had to buy homes with terrible roofs, poly piping, all that nasty stuff. You're buying that because you're like, I need a place to stay.
Contract.
As is. It was a true definition of as is, literally.
Exactly.
And the worst part was you were overpaying by a lot. So think about, let's flip the switch here a little. So I buy a home, roof is 15 years old. I have to pay for it. Now piping, I have to fix it. Paint, I have to redo it. Plus I'm paying everything else, and I'm paying, guess what? 40 grand over market. So all this is costing me 70, 80, 90 grand, almost 80 grand over what it's supposed to be worth. Yes, one of the years property appreciated by 30%, but that's not going to do forever. So now if some people who actually overpaid for their homes last year, including some family that I personally know, if you look at the AVMs, they're negative right now in value. They haven't gained any equity.
Nope,
but
they haven't.
They needed a place to stay and they bought a home.
Yeah,
they have a 2% rate, but what does that do really? Nothing. It's 2% rate. Okay, fine. Yeah, it's a cool interest rate. But again, you're looking at the wrong picture, because now you are out of 100 grand that you could have had preserved. Now, real estate is a way to build long-term wealth. And to your point, man, today there's so many regulations, especially things called Truth in Lending Act and Disclosure. You have the ability to pay. Underwriting guidelines are much different. Nobody wants to give you money today because there's not a lot. And I don't want to give anybody money, so they default. The other thing is, you got to know who you're working with. Because, see, the thing is, in this space, what I do is I don't do loans. I help people build a long-term plan to build wealth. Now, that's through the asset class of real estate, unlike anything else. Now, if you're not ready to buy, you shouldn't buy. If you can't make that payment, you shouldn't make that payment. But yes, especially today, and I know it sounds cliche, like right time is the time, now is the time to buy, but it really is. And the reason why, let's take an example. So if you want to be, I like the 400,000 number. It's easy math in my head. so let's be conservative here, right? So let's say property discounts, instead of 20%, you're getting between 5 to 10%, right? That's it. We're not going much here. We're going very conservative. And on a $400,000 home, you get, let's say, 2% off. That is $8,000. Now, you can either take that money and discount it to $392 and tell the seller, okay, yeah, cool, I'm good. Or I'm not even include closing costs here. I'm just going to include the 2-1 buy down as an example. Instead, you say, hey, listen, take the $8,000 and do a 2-1 buy down on my home right now. And that would average cost about $8,000 to $12,000, right? So even if we go to $12,000, and this saves you 2% interest per month in your payments for the next, let's say, first year. Now, for the first year, you will save roughly $300 to $400 easily per month in your payment, and at a lower rate on a house. And you got a deal on that property, right? Because you're underpaying it basically. Now, if that house appreciates in value by, let's say, 5%, or let's say even 3%, not even 5, 3%. So I got 2% off. It went up 3%. So total is 5%, right? So
Right.
at the end of 1 year, if my gain on this property is 5% on a $400,000 home, that's $20,000.
Right.
Now, $20,000 I made at the end of the year. Now let's go realistic here. If you made $100,000 in your W-2 income, salary, 100 grand, government takes taxes. Let's say we're paying low taxes, 20%, you make 80 grand, right? That's 6,600 bucks roughly, 66,667, whatever, but 6,600. You pay your mortgage and roughly about 2,000, 2,500. You pay your insurance bill, car bill, eat out, shop, buy for kids, blah, 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 blah. You're lucky if you could save $500 a month.
Yep. Yep.
So if, let's say you're super lucky and you save 500 every single month and you do it, at the end of a year from saving painfully, you made $6,000. Where else can you go and make 20 grand just like that? You made that in a year. And you live in that home, by the way.
Yeah.
And now that value is constantly appreciating. So just to be extremely negative and very conservative, this is why it's a great time to buy a deal. Now, you can go further with this. You can get a discount. You can have them pay for your closing costs, and you can pay for the buy down. So you can do all these three things depending on a combination. And there's a really cool thing you need to do. Find a really good agent. Like there's this guy named Mohit Badlani in Florida. No, but jokes aside, you need to talk to a real professional who is not going to just try to sell you, but who will basically break down the details to help you understand what you should do. I think that's important.
I agree. That was a lot of good stuff over there, man. You learned a lot.
Man, you just got my brain working, man.
We learned a lot today, and usually our episodes are between 20 and 25 minutes. We got 40 minutes worth of great stuff. Now, if someone wanted to reach Yahya, how would they reach you? My co-host for today.
You know what? I'm taking it. I'm the co-host. Thank you very much. I love the co-piloting. So
there you go.
So I'm easily reachable, guys. I have a very unique name. I haven't met any other Yahya and last name Chitani anywhere. So just type me on Google. You'll find me. Instagram, my handle is my first name, last name. I have some really cool short form videos there. And yeah, we'll find there. But you know what? One thing I did want to tell you is you asked me about the housing forecast.
Right.
And I don't want to go too detailed into it, but we'll hit them with some bullet points. So
sure.
We are going to see lower inflation. Like we said, the Fed is rigging the game, so they're going to rig it again. So they're targeting inflation to closer to 2%. So it's realistic to see that between 3%, 3.5%. We'll see that. And that will cause a recession, obviously, right now because they've raised rates so high. So if we see that, lower inflation, we have a recession, and incomes are increasing, like you pointed out, basically. So it's better for affordability. Right. So inflation comes down, rates come down, affordability goes back up, and rents are still expensive, which you're saying is correct, especially on that JP Morgan Chase announced that they're going to buy $1 billion worth of single family homes to invest for long-term investments.
Yeah.
So that tells
there's
you
a reason for that.
There's a reason.
Yeah.
There's a reason. So we're not going to go into that, but we still have a tight inventory environment, like you said, you and Judson talked about. So yeah, we may see this slump. So the opportunity, guys, and this is the real advice here. Right now, until maybe May, June, you will see a good amount of inventory to buy. But as soon as that period goes away and rates come back down, where you were saying, we're also expecting them to be somewhere in the lower fives, probably high 4s to 5s, maybe closer to next year. But this year looks like we may be able to hit a 5, right? A little bit low 5. Kind of like mid 5, maybe around there. But if that happens and these 5 million people hit the market, you're going to have, again, the same thing. You're going to have to find a home. People want to pay for it. They need a home.
Multiple offers.
Why. Exactly. And home values should go up in the entire United States as an average in single digits like we talked about. So if you want a deal, right now is really the time because later part of the year, you may not have this opportunity. So really consider this. And what I would really love to leave everybody with is please talk to someone who is interested in building you a clear plan to build wealth for the long term and not just look at short-term goals, because it's very important you understand that. The difference between a good agent and a bad agent, I would say, or I wouldn't say bad agent, but I would just say a good agent and somebody who doesn't know. yeah, what they're doing. Maybe, they just, everybody's passion is different. Not all
Right.
agents are built the same. Some agents, like Mohit here, you do this full time, you've done this for years.
Right.
If I get a license and I do real estate part time, I really don't know much about what I'm doing. So maybe it's a hobby. So not to say bad, but know who's serious. Same thing with lenders. Some lenders are focused more on long term advice, and a lot of lenders, they just join the industry. Maybe they don't know what they're doing. Maybe they're used to working in an environment where they're just quickly just doing transactions,
Right.
but they're not really taking time to build you a long-term plan. So talk to somebody who matches your personal, I would say, needs, and go from there. That's something that I would tell you.
Fantastic. Great advice there. Great advice. Now we want to hear from you guys. You can reach us at our Moving to Florida show hotline by dropping a voicemail or texting us to 407-900-5859, or drop us a DM on Facebook or Instagram at Moving to Florida show. And for Twitter, our handle is at Moving to FL show. If you would like to connect with us, if you have any questions, or if you need a realtor in Florida, you can reach us at movingtofloridashow@gmail.com. Be sure to subscribe to the show if you like our content, so that it would automatically download to your device and get you one step closer to moving to Florida.
Wait. I got to step in there. Because I am the co-host, and I got to redo this. I'm like, no. Be sure to sign up and subscribe right now, because guys, what Mohit did not tell you, and he doesn't even know this because I'm telling it to you right now, is we're going to bring a lot of energy to this show. We're revamping it. And I don't know if you guys can feel it, but I have a lot of electricity going on here. What I really want everybody to know is, guys, for a long time, our industries have been very boring. And we're changing that. We're going to make it more fun, more simple, more easy, but bring you guys a lot of amazing content. So please do subscribe to the show. And if you have any specific things you guys want to learn, let Mohit know. And we'll bring you guys some awesome content. And this is the co-host of the day.
Yeah, I appreciate you being in the co-pilot chair today. I appreciate that. Thank you so much. All right. We're also going to have Yaya's information and contact information in our show notes. So be sure to keep an eye on that. All right, guys. Thank you.
All righty.